Welcome everyone. Thanks for coming. Like Liz said, my name is Robert Mafara with My Commercial Capital. First off, I want to thank Liz for setting this up. She did a great job helping me. She advertised it, marketed it, and now I'm here. So welcome, first one of the year. Also want to thank Chesapeake Think Tank. They helped me put this presentation together, so hopefully you enjoy it, and also motivated me to get up here and do this in front of all of you. It's not easy. So just looking to, so hopefully you all enjoy it, and we'll get right into it. So today we're going to talk about working capital. Working capital is important for your business. I know I've been through it. I've been self-employed for 20 years. I've owned several different businesses in different industries, and I know what it's like to need money and not know where to get it from. I was younger when I bought my first business. I was 24. We had a business for a year or two, and we needed money. I wanted to expand. We went to the bank to try and get a loan. I had great credit. I had good sales, but I had no collateral. I was still living at home with my parents, so I didn't own any real estate, so I couldn't get approved for a loan. It's not that easy. And I wasn't aware of private money lenders where you don't need collateral to get loans. So it was a learning experience, and that's why I got into this field, because I like to be able to help other business owners get funding that they need for their business to help grow it in ways. And the goal would be to have a strategy to grow your business so that your sales could double or triple with the working capital that you receive. So working capital, what is it? It's basically the money that you have daily to pay for your daily expenses. So if you have payroll, marketing, supplies, anything like that, that's what working capital is. Working capital loans are short-term loans. They're usually 1 to 2 years, or less, could be less. And they basically give you money to put into your business to help it grow. It's not meant as a long-term investment. The basic formula for it, if you take your current assets and minus your current liabilities, that's your working capital. So to put it like numbers to it, let's just say you do $5,000 a day in sales. Say you had a 20% profit margin. So your liabilities would be $4,000 in that particular case. So then you have $1,000 of working capital. Does that make sense? So you have your assets, your liabilities, and then that's what you have left to spend on whatever else you want. Benefits of working capital loans. So these are a lot. I'm just going to go through and read them to you really quick, just in case you can't see the screen, and then I'll elaborate on some of them as I go. So benefits of working capital loans. They're meant to meet your short-term financial needs. So like I said, it's either if the best strategy or the best use of it is if you're going to grow your business. But if you know you need money today, you have sales coming in, it could also be useful for those purposes. Where it would not be good is if you're using it for bailout money. You shouldn't be getting it if you just need to bail out your business and your sales aren't going to maintain or grow. Number 2, take advantage of opportunities that arise unexpectedly. I mean, you know that better than me in your own businesses, but you never know when something pops up and you want to take advantage of that opportunity. These type of loans could help in those type of situations. Tide over during periods of slow business. This one requires planning. This happens all the time. I get people come to me, their business is slow, they need money for their business, and they waited too long to come to me. Because a lot of the way they figure out how much money that you can get is based on your sales. So if you come to me while your sales are strong, then I can get you more money. Whereas if you wait too long, like if you have a month that's poor in sales, I might not be able to get you anything. And not just me, no one. You can't get finance. So planning, like if you know that your season is going to slow down ahead of time, you should get the loan before it slows down, so that way you'll have it for when it does slow down. Finance inventory and receivables. I'm going to get into this more in a little bit, so I'll just save it for then. Finance the expansion of your business. You never know, you might add a room to if you have a restaurant, add outdoor seating. Just little things that could help grow your business. But like I said, you always need a strategy. So whatever you get the money, know what you're going to use it for before you actually get it. Because it's not cheap. Money's expensive. So you don't want to be paying for it, and you start paying for it immediately. So you don't want to, when you get it, you want to know what you're going to be using it for. Meet your payroll expenses. I mean, this has happened several times. You have payroll due today or tomorrow, but you don't have the money in your bank. You will next week because you're going to get that check from your client, but that's not helping your employees today. And it's happened to me before where most business owners would like to put their employees first. So instead of telling their employees, hey, look, I can't pay you today, give me next week, I'll get it to you. And obviously they're not going to be happy with that. So the owner could get this short-term loan, get the money, pay their employees, and then pay it back the following week. A lot of times these lenders don't have prepayment penalties, and sometimes they'll give you discounts if you pay it early. Finance the purchase of equipment. I mean, this happens a lot. I know like landscapers, they buy another lawnmower. Now they can cut twice as many lawns, or they can finish twice faster, or 2 times faster. So there's different ways. Equipment like trucks, you can finance vehicles. But whatever the case, whatever equipment that you're looking to buy, just make sure it's going to benefit your business. Tide over during period or cash flow difficulties. This goes along with number 3. If you have a new idea that you want to put into your place of business, whether it be a new product that you want to sell or a new service, you're going to need money to purchase those kind of things. And then also number 10 is just to market that idea. So you'll need money to implement it and then to market it. So the different reasons that you may need money for that business. So pros and cons for working capital. And I have time at the end for questions, but if anybody has any questions throughout, feel free to ask. But I'll go through these real quick. Pros, they're quick to fund, depending on who you get it from, but typically you can get money fast. It's common that you can get funded the same day that you apply. Little or no collateral required, and paid off fast. So like I said, they're short-term loans, usually within a year, 2 years tops. The cons of it, you might not get approved for as much as you want, but like again, they're basing it on your current sales, so they want to make sure that you could pay them back based on your current sales, not on what you expect it to grow to. They may require more frequent payments, so when you pay back these type of loans, they're usually daily or weekly. So me personally, I like daily, so they take a little bit of money out every day, whereas it's not like a big chunk every week. And it's an auto deduct, so they're just going to take it out automatically from your. So they cost more. And some of them require a personal guarantee. So now you know what you need. Then you got to figure out where to go to get funded. So there's different places you can go. There's traditional banks. So there's no bankers here today, so no one to defend that. Private lenders. That's kind of where I fall into play. And then family and friends. Family and friends or savings account. So you have your savings account. Once you go through that, you might talk to a family or friend. Obviously, family and friend comes with its own interest rate. It's like pressure. Heaven forbid you go to the movies and you still owe somebody money. You have that like feel of guilt or pressure. You just want to pay them back as soon as possible. So it could be a lower cost, like financially, but it's a higher cost in the mental, because you just want to get it out of, be done with it. Traditional banks and private money lenders, I'll do like a side-by-side comparison with these two. I listed 5 factors that they look at. Obviously, you need to qualify for the loans. Traditional banks are great. They're great for about 20% of the businesses out there. Unfortunately, 80% of the businesses won't qualify for a working capital loan. and there's just so many different factors. One of them is credit score. Traditional banks usually require a higher credit score, usually 700 or better, whereas private money lenders could get approved for a 450 credit score. Profit level. They both require you to be profitable. They're going to look at your sales, and depending on your sales, obviously they want your sales to keep going up. If your sales are going in a negative direction, it's always a concern as well, so that's something that they'll look at. Time in business. Traditional banks usually need 2 years in business. Private money lenders, you need 4 months in business. They're only looking at the last 4 months bank statements, and then based on that, they'll approve you for whatever you qualify for. Time to fund is important because if, traditional banks, like I said, they're great if you qualify for them and you have a high credit score, but then you still have to wait for the time to get funded. Usually it takes about 30 days to get your loan. Where private money lenders, like I mentioned, it's common to get it the same day or the next day. At the most, 3 days, like within 72 hours. Usually the time that it takes is just you deciding if you want to take the loan or not. They're going to get you the offer pretty quick, and then, you just have to figure out if it fits for you. And the last thing is real estate collateral. So like I said, when you go to banks, they usually require collateral to get your loans, and usually they want 125% of the loan amount. So if you get approved for a loan for $100,000, they want you to have collateral of $125,000. Does that make sense? Sign their house to the loan, or their wives don't want them to put their house on the loan. So they say, we'll pay the extra interest and not have that guarantee. And if things go down, they're not losing their house over it. So there's so many different types of working capital loans. I basically put the top ones. Short-term loans, as I keep saying, they're short-term and they're expensive. So you got to have a strategy or a plan to put forth for the working capital. So invoice financing and PO financing. This is pretty cool. This is something I didn't know about until I got into this.
You said questions during short-term loans, like 2 years, 1 to 2 years?
1 to 2 years. Yeah, it's sometimes 4 months. It just depends on how much you get.
But not like three plus years?
Correct.
Okay.
Is there a limit on the loan amount for short term, like $100,000 that you have to pay back the first year?
So yeah, good question. Both of them were good questions. So it just depends on the situation. Typically, like if you do revenue-based financing, they're going to give you 1 to 2 times your monthly revenue. So it just depends on your sales. So in that particular case, if you did $100,000 in sales, they're going to give you between $100,000 to $200,000 a monthly if you do that in a month. There are other loan products that I'll talk about too, where you can get where it's just based on your credit, and they don't even look at your sales. So they have different types. But as far as the limit goes, it's 1 to 2 times typically of your monthly revenue. So I can go up to $1 billion. I haven't done one of those yet, but that'll be pretty cool. Did that answer?
Yeah.
All right, cool. So invoice financing. So this happens a lot where, say, Tommy, you had a job, you drove to DC, you sold $10,000 worth of product. You sold it to them, but that client's not going to pay you back for 30, 60, 90 days. So what do? You already used all the money you had to buy the product to sell to them, so now you're sitting waiting for your money to come in. It's really poor cash flow because you can't do anything. So they have these type of loans where they take your invoice and they're going to look at who owes you the money. So it's not bad debt. Somebody that's going to pay you within 30, 60, or 90 days. They're very short term, so no more than 90 days on these. You present them the invoice, and they'll give you the majority of that money up front, and then the balance when the actual vendor pays you. Does that make sense? So you don't have to wait, so you can keep your cash flow going.
So you use me as an example, which is good. Because sometimes I'll come across some government contract bids and they don't pay for 30 days.
Right.
And sometimes the bids are too high, I won't bid on it because I know I can't pay the invoice because they're not gonna pay me for 30 days. I'm talking like $15,000 or more.
Yep.
So you're saying in this case, if I had that purchase order from the government showing, I'd be able to possibly get a loan to be able to pay the vendor, because my vendors need to be paid up front.
Yeah,
I mean, perfect scenario. Is that what you're telling me? That might work?
it can, but they want you to pay it up front. So, like, I had a situation where I had a woman, she was selling coffee to the government, like lots of coffee,
Okay.
like $50,000 order. And she wanted to wait till somebody ordered, and then she would put in the order. But the lenders want you to pay that $50,000, but once you pay it, they'll give you that money back. So you're not waiting the 30 or 60. And government, they say 30, but usually it's 60 or 90. So yeah, you can get funded and not have to wait the 60 or 90,
Okay.
and that way you can keep your cash flow going.
Forward, okay. Cool, thank you.
Yeah, it definitely help. And when you know about it, you can price in that rate when you present your offer. So sometimes these type of loans, they're pretty cheap. They're like 3% or so, at least what I've seen. And they're short term, so 30, 60, 90, and it goes up a little bit once every month. But it definitely helps with cash flow. Credit lines are great. If you qualify for them, they usually are a little bit harder to qualify for, but you could just have an open line of credit in your business, and it just sit in there, and then when you need money, you can take it out, and you only pay interest on what you take out. So it's just there for when you need it. And equipment loans, you might need to buy a new vehicle, whatever the case may be. It's important to know what you're buying and what it's going to be used for, and then have your projections on how much revenue, what's your ROI on whatever you buy. Or it could be a situation where you just need it to keep going. Small Business Administration, so SBA loans, I'm sure everyone's heard of SBA loans. They also do working capital loans. SBA loans, like when you come to where to get funded, they're going to be the traditional banks. They follow all the same guidelines as traditional banks. So even with the SBA loan, you still need to have a good credit score. You still need to be profitable. You still need to have the time in business. It's going to take time to fund. Usually it could take 30 to 60 days for those. There's no guarantee that you're going to get approved for SBA, but it works for some and others it doesn't. And same type of expenses you can use for as far as the working capital goes. So here's one of those products that you can get if you don't have any sales in your business. If you're a new business, they have a product where it's called unsecured business funding, where they don't even look at the sales of your business. It's completely based on your credit. Usually you need a 680 or better. They don't budge on that. And you need to have multiple lines of credit and things like that. But they will offer you up to $150,000 in financing at 0% interest for the first year or two. So it's great if you're a new business because you don't have any sales. So this could get you started in that. It's also good for real estate. If you're looking to buy a commercial property, like a rental property or a fix and flip type property, you can get a loan for the property and then use this as your down payment. Because typically when you buy a commercial property, they want 20% down, 10 to 20% down. But so if you buy a $100,000 property, you need to put down $20,000. You don't have $20,000. You can try and apply for this loan to get the $20,000, and then get the other loan for the balance. Does that make sense?
I'm interested. So timing-wise, you have to have this well ahead of time. This unsecured business funding for the down payment before the mortgage company would consider your assets, I guess.
So mortgages are different because they're a lot more regulated. So requirements. So planning is also key. They usually want to have it. So when you do a mortgage, they source all the deposits in your personal bank account. So if you deposit it into your personal, they're going to want to know where you got it from, who gave it to you. Now, if you get it deposited into your business account, business accounts don't need to be sourced when you do home mortgage or stuff like that. So, and you're allowed to take money from your business to put into your personal for a down payment. So usually it takes about 30 days to get the loan, but you're going to get it deposited into your business account, and then you can use it from there to pay the down payment. So, and like I said, usually it takes about 30 days, so your planning would be to have it in there at least 30 days. It's hard to get approved for, but if you get, you got to have, you just have, I mean,
Start
yeah.
with that 680.
yeah, you need 680 or better. It's pretty, they're not, they don't budge on that. It's, if you have a 660, you know, it's anything lower than that, it's not going to
Easier,
work.
like you're at 770, is it?
Definitely more benefit, but that's like the minimum.
That's just where they start their minimum. Got it.
Yeah, so like I won't even submit it if someone tells me they're less than that. But the good thing is, even if you don't have a high credit score, if you know someone that does, they accept cosigners.
Oh, wow.
So they'll look at their credit and deposit it into your bank account.
Oh, wow.
Wow.
So it allows cosigners, you know, and they can get it. And you know, you tell your friend that it's not going to actually show up on their credit report unless they default on the loan. So you want to assure them that you're not going to default on the loan so that you can use their credit to get approved. But yeah, did that answer your question?
Quick recap.
Good question.
So this UBF, is that with private lenders or we are talking with traditional banks?
Private lender.
Private lenders.
I didn't mention it earlier. So I'm a broker, so a loan broker and a business broker. So for loans, you know, I'll take your one FICO score and then I'll present it to like 10 different banks. So you're not running your credit every time. I'm doing that on your behalf. I'm not giving them your social and things like that. I'm giving them the scenario. And then I try and find the best deal for you. Did that answer your question? All right, cool. A little bit more on unsecured business funding. So they have secured and unsecured, just depends on what you're looking for. Unsecured, you're going to pay a little bit higher interest rate because it's more riskier. That's all these lenders are doing. They're just evaluating how risky the loan is, and then they give you the rate according to that. Some businesses, depending on the industries, they'll give you higher credit limits. I know like restaurants, for some reason banks don't like restaurants, probably because they have a high failure rate. But private lenders love them. So I can get them money quick. I even have products where there's a revolving line of credit. So they'll give you a larger amount that you would get approved for as an emergency. So it's there for when you need it. Fast pre-qualification, guaranteed low rates. So the lenders I deal with, they've all been vetted, and they know that I'm shopping to get them the best deal. So they're all giving me their best deal, so that I take their best offers and then I'll present them to my clients. But you could always go and shop it as well.
And drive your credit score down 20 points with all the hard.
That's a good point. So a lot of times banks will do hard pulls. So all the private lenders I deal with will do soft pulls, at least to start. So they'll do a soft pull just to see where you're at. And then if everything goes through and you're ready to sign, eventually at that point they'll actually do a hard pull.
So is it the personal credit score of the owner or the business credit score?
Owner. Yeah, good question. But it's,
The owner.
yeah,
But it would be their
personal score. Yeah.
score.
But it will help increase their business score. Like I said, most of these payments are daily or weekly when you're paying them back, and they're reporting it every time you pay it back. So if you're doing daily payments, every time you make that payment, and I say make that payment, but they're just taking it from you. It's automatic. It's automatic withdrawal from your account. But they take it daily and they report it, so it'll help build your business credit.
So I don't want to get off track, but maybe it's the same thing. There's a Dun and Bradstreet score for your business. That's something totally different.
Yeah.
So that's a different type of loan that would be used for?
Yeah. These lenders just use your FICO.
Okay.
which is what most lenders use. But good question. What,
The only reason I asked is I got something literally from something saying, hey, we can get you a loan. Your Dun and Bradstreet's score is over 70. It's like, what the hell does that even mean?
More vendor
What's Dun and
credit.
Bradstreet?
That's
Sounds like a
more
sales.
vendor credit.
Okay, and that's what I was trying to figure
Yeah.
out. Okay. So a little bit different. You're talking FICO scores. Okay, cool. I got you. Roll on with your presentation.
all right. Another loan option, merchant cash advance. Let me go through a little bit quicker. So merchant cash advance, also known as like MCA, is like the short version. For these type of loans, they only look at your credit card sales. So based on your credit card sales, they'll approve you for a certain dollar amount, and then they'll take it out every day, like a percentage of your credit card sales. So it's just automatically deducted based on your sales. So they're basically giving you an advance on your future sales. So you're getting an advance, and then on your future sales, they just start taking it back until it's all paid off. And then they'll offer you to get more. Any questions on MCA? All right. Business revenue financing is next. So business revenue financing is very similar to an MCA, but now they're looking at all your income. So they take all of your credit card sales and all of your cash sales, or any sales that you have for your business. They add it together, and typically they'll give you 1 to 2 times your monthly revenue. I keep saying the best situation for this is if you have a strategy to grow your business. And they usually will give you that money within 72 hours. Some things that can hurt your chances of getting this, it's not your credit score, so they don't even care about your credit as much as your sales. They're looking at what your sales are, and not just deposits from banks and things like that. They actually have to be sales. That's all verified by the banks. But if you're writing bad checks, that's going to hurt you. They're going to be like, why? Low frequency of deposits. If you only have 2 deposits a month in your bank, it means you only have 2 customers. That's a concern. So they're going to want to know why. Low average daily balance. So this is also a concern. You know, if you do $3,000 in sales a day, but never have $3,000 in your bank account, you know, what's going on? So the lender's going to be like, they don't know if you're mismanaging your funds or if you have high expenses, but it's definitely going to be a concern for them where they might not approve you for that loan. So I got a little example here for you to try and figure out how much does it cost. Because I keep saying how it's expensive. so I drew up an example just to give it to you. So in this example, let's just say your last 3 months of sales were $50,000, $42,000, and $53,000. You get that? So those are your sales. And based on those sales, they're going to give you 1 to 2 times your monthly revenue. So let's just say in this particular case, they approve you for $60,000. You got that? So with that $60,000, just say in this example, you're able to put that money into your business because you had your strategy to grow it, and you're able to grow your sales to $93,000, $102,000, and $105,000. Those are your next 3 months. So in this particular case, you're going to take $60,000, put it to your business, and then pay back within a year, but you grew your sales by $40,000 a month. Still haven't told you how much it costs. So we'll get into that. 4 to 18 months, that's the term. In this particular case, so they usually charge you 1.2 times to 1.5 times whatever you get. So whatever the loan amount is. So say if you get a loan for $10,000, you're going to pay back $12,000 to $15,000. If you get a loan for $100,000, you're going to pay back between $120,000 and $150,000. So it varies, and there's other factors to figure out if you're at that 1.2 or that 1.5. For this particular case, let's just say they charged 1.3. So you have the $60,000, 1.3 of that is $78K. There's usually about 20 banking days in a month, right? So you don't pay on the weekends. So about 20 banking days a month, which turns out to be about 240 payments a year. So your payments would be $325 a day. that make sense? So in this particular case, your sales are 60,000. So if you take 60,000 and divide it up by 240, it ends up being around $3,000 a day. So your income is around 3,000. The loan is going to be about 325. So you still have about 2,700 to pay for your expenses. Does that make sense on that? And then I put in there your weekly payment. So like I said, I like the daily because they're taking out $300 a day. Whereas if you do it weekly, it's about $1,500 a week. So it's just a bigger chunk, and you'll feel that a lot more than you'll feel that smaller amount. So in this particular case, how much does it cost if you don't do it? If you don't take the loan, I mean, you're pretty much going to stay at that 42, 53,000. So these type of loans, like I said, they're expensive. But if you have a plan to move it forward, these type of loans can be priceless. Because you can't get to that 93K a month without that 60K revenue to get you to that level. And then you start making 100. So in this example, would you mind paying $18,000 in a year if you're going to boost your sales by $40,000 a month? All right, see how it could be? It could be priceless for your business if it's applied the right way. But at the same time, if your sales are going down, now you have that daily payment of $325 because they said, okay, well, if you're making this much, you should be able to afford this much. But if your sales go down, you still have that same payment, but you have less revenue. So this money can get expensive, and that's why I say if your sales are going to go down, it's not right for you. Unless you need it and you know your sales are going to come back up, or if you're using it to grow, then it could be worth it. Any questions on? All right. Finishing up. So then, you figure out how much is it going to cost. Now you have to figure out where to go to. Luckily, you all know me, and I can do this for you. But if you don't want to use me, there's so many other lenders out there that you can go to. Some of the things you want to look for is the loan features. You want to see what they offer you exactly. You want to check out the interest rates that they're charging on the loans. You want to check out if there's any additional fees that they're charging, because sometimes different lenders sneak stuff in. So you always want to read the fine print. You want to check and see if there's a penalty to pay early. Qualification process, application process, these two things kind of go hand in hand, but you want to see what it takes to get approved for a loan, and then what do you need to apply. Traditional banks, usually they need 2 years tax returns, you need to fill out a long application, and it requires a lot more documentation. Whereas private money, 4 months bank statements, no tax returns. It's a lot easier. Customer support, this is huge. I mean, I didn't even realize that like Facebook and Google doesn't have a customer service where you can call and get help. So it's important to look and see the lenders to see if there's someone you can contact. Go to their page and see if there's a call me or an email. Like, you want to make sure that you can be able to get in touch with them in situations that you might question something. So it's always important to look at where they're, if they're going to be responsive to you. User reviews, there's so many reviews out there, and there's just so many sites like Trustpilot where you can look and make sure that you find reviews on that company to make sure that they're a reputable company. And perks and bonuses, sometimes they offer discounts if you pay it off early. So that, like I said, you want to make sure that they don't penalize you for paying off early, but in some situations they'll actually give you a discount if you pay it off early. And that concludes the presentation. Does anyone have any questions for me? Sure.
Talk about the importance of not commingling your personal account with your business.
Okay.
And you know what I'm talking about. But I'm not going to name it.
So yeah, we've had a discussion about this in the past, so this is good. I'll bring it up to other people. So sometimes people start businesses and they don't do everything the right way. And you start off and you're depositing money into your personal bank account. To get these type of loans, they want to see your business checking account. So a lot of times, well, I've had situations where people come to me to get financing, and if you don't have a business bank account, you're not going to qualify because they want to see the strength of your account. Is that what you're looking at? Or okay.
The importance of separating.
Yeah, so you want to keep them separate. You want to keep your books separate. You know, if you're accepting credit cards, get that into your business account, not to your personal, and move it. Because I mean, when that time comes that you're going to need funding, you're not going to be able to get it because the lenders look for that kind of stuff. But the strength of your bank account is huge.
I got a question regarding your loan through the credit card, where they'll give you, it's called the merchant cash advance. I know exactly what it is. So my question is more a direct scenario. So right now, my credit card person who I've been using for 5+ years charging, sees the charges, like you said. So they reach out to me and, hey, we'll give you a loan and it's a flat rate. You know, like we'll loan you anywhere you pick the amount from 4 to 10,000. Depending on what I pick, they give me a rate of anywhere from 6% or 4%. I don't have to go back and look. Way better than the bank though, or way better than what I'm getting anywhere else. I think anyway, maybe not. And then depending on what I borrow is my payment that I'm supposed to pay every 60 days. But every time I charge, they take a percentage.
Mm-hmm.
And that way, if I don't have that amount taken out by 60 days, then I never have an issue because, this is where I'm going with my question, I've done it now, I'm on my 3rd loan from them in a row because the first I paid off and I was taking off, because then it just comes out of my sales. And I've never, ever even been close to not having enough paid after 60 days. How would I go about that with you? Is there somewhere I could because right now it's going, would I have to change credit card processing to see if those are better rates for me going that rate? Because I'll almost have this last one paid off, and I'm about to do it again. But you see what I'm saying? So would it be beneficial for me to look and see that way, or just stay with the way I'm going since I've already been using this credit card processor for 5 years?
So, good question. With the credit card, you don't have to change your processor. The lender will evaluate your current situation,
Okay.
but they just want to make sure that you can pay it back. So that's what their goal is. And
Maybe I should look into that, 'cause if I can get a better rate for a better loan, obviously I should go that way.
in that scenario, I like the revenue-based financing because if you have other sales besides credit cards, because you can get more.
Yeah, and I do. Just 90% of my sales are credit cards. I do get checks.
So you could
Bank account, but it's them seeing the credit card charges literally daily. They're like, hey, we'll loan you more.
yeah.
We'll loan you more.
So they'll look at that too for the revenue-based financing.
So, okay.
So that's basically what they do. They look and see.
Information.
They want to figure out how much you can pay back. So they're going to evaluate your situation. Say they look at it and say, okay, he can pay back $200 a day with his current sales. So $200 a day. There's 20 banking days in a month. That's about $4,000 a month times 12. So it's about $48,000 a year. So I say, okay, he can pay back $48,000 a year. Let's give him $40,000, and he'll pay back $48,000.
I got you.
So they don't calculate it by how much they want to make.
I understand.
They calculate it by how much you can pay
Yeah,
back.
this is based on everything. Depends on.
So that
If I took a $10,000 loan, my payment was going to be more, and my interest rate was going to be more. If I took a $4,000 loan, hey, well, they were only going to take out 5%. And on one loan, they were taking out 15% of my sales. So then when I paid that off, I'm like, I don't need that much anymore, so I cut it down. Now they're only taking out 5%. Well, that's a big difference to me when I'm seeing that. But either way, I know what you're saying. It's based on literally what you're taking, how much you're taking, when you're paying it back, how much you can pay. So as long as they can see the numbers in the business account. And what Liz said is true, keep them separate. You should have a business account and a personal account.
Yep.
That was the first time I made a mistake my first couple years in business. That was 8 years ago, though. Now I'm straight.
The one that you were talking about for like down payment. So I've worked with a couple investors that buy and sell properties or buy, rehab and flip. So they're an individual buying the house or buying the property, but to apply for that down payment loan, they would need to have a company set up.
like an LLC
An
or
LLC or something, okay. Because what they're doing now, from what I'm seeing, and I'm not gonna name any names, but they're just their name. And if they got the loan, they would have anywhere to put it but their name. So then it would have to be sourced. So they would need to open an LLC.
Yeah.
Okay.
And I would recommend that too, because it
Yeah.
takes away their liability
They
if
have,
things
and that
come
can
away.
make more.
Yeah, I've done that before. You start a corporation just for buying and selling. Just in case things go south, they're not going to come after your personal.
Right.
Most attorney
Assets.
I spoke to, if you're gonna buy and sell real estate, you need that LLC.
Yeah.
Yeah.
And if you're going to rent it, you need an LLC for every single property.
Yeah.
Yeah.
So I used to bundle so
Every
many
property
with one
needs
unit.
an LLC.
But I've seen some of them, they go through, the lender won't do the property in the LLC. They want it in the individual's name, but then they'll transfer it into the LLC after they've purchased it. But doesn't that open them up to other, like, issues or whatever?
Yeah, I think it depends on the situation of the person, because they do put it in the business's name too. I know I've bought properties and I always put it in the business name. And why you want to do it for each property is because you're protected more.
You're protected, right?
That's it, that's your-
You can't come after every.
Yeah, they can't come after them all. But if you have, but you,
There's a couple of them that do have like a half a dozen properties under one LLC,
Mhm.
which I guess would potentially be dangerous
if something happens, yeah. So, but it's up to you. So you could bundle so many or not, but it's on your. And then some people don't do it at all. But I would definitely always recommend, because it's so easy to get that nowadays, and it's all online. So you can start an LLC same day.
15 minutes, you're done. If that.
But do you do a tax return for each property?
Yeah.
Each one would get a 1065 tax
You
return.
probably have to, yeah.
Yeah.
You would wind up with a K9,
K1.
K1, that would go on your personal return for each property.
Yep.
Is there any difference between bundling 7 properties and having 7 individual when it comes to tax reasons?
Yep.
It's going to cost you more when you get your taxes done,
What,
'Cause-
if they're bundled or if they're?
No,
if they're individual.
because you're doing 7 different returns.
You're doing 7 returns. But if, say, one property burns down and somebody dies in it, they can only sue you for that one
So
property,
there's pros
not
and cons to everything.
the
Yeah,
seven.
I got you. Pros and cons, just like.
Yep.
Okay. That makes sense. All right, very interesting.
I mean, that's a terrible
No,
example to use.
Right.
You know,
Always prepare for the worst
case
Exactly. Prepare for the worst, when the best hits me, I'm good.
Exactly, 100%.
One that paints a picture you definitely understand now.
Yeah. And I love talking about business. So if anybody ever wants questions or wants to meet up and talk about it, no, I'm happy to do that.
Question would be, a starter business, do you like, would sit down and help with the number to strategize to see how that can help excel?
Yeah, I can. And like I said, it just depends on the business, if it's a franchise or not a franchise. But and just finding out what's the best situation. But yeah, absolutely. Because sometimes SBA loans are good for startups as well. They just require a lot more paperwork, and it takes longer. Sometimes 60 days or more to actually get approved. But you'll have the best rates and terms. So a lot of it just
With SBA, you're saying better loan
Typically.
pricing?
Feeling like SBA loans are going to start pinging that BOI list to see if you registered as part of a requirement.
it's very possible.
Would be what?
The beneficial owner information I sent out the
Oh,
email
oh,
on.
oh, that one you're talking about.
Yeah.
Oh, wow.
Nightmare.
Completely new to me, I'm like.
Oh, boy.
Any other questions?
I think I'd rather stay away from it.
So I
at
got-
this moment.
You don't
Not
have a
scare me.
choice.
Yeah.
Not
You
scare
have to,
my-
right. Thank you very much.
You only have until January 1st,
Right.
2025, period, to register.
Yeah, just email me and I'll hit
To
you right.
register as a,
Yeah, the beneficial owner information.
okay, now you got me. It's like, okay, what are you talking about?
So I have some, if anybody wants any little brochures about some of the private lenders that I work with, for working capital, these are only for the working capital and the pen. Obviously, if you need any of this stuff, Tommy can help with that.
I'll take one, cause I would've been.
Yeah, if anybody else wants one, I got them all laid. I can hand them out to everybody, but if it's just gonna be trash, I don't want to give them to you. But
That's how you do it, right?
if anybody wants one,
That way you know what they take their
get my card.
Tell them that I got capital through you.
Oh, okay, cool. So Tamika, I don't mention my clients, but I was actually able to help her get financed for her business.
My first business line of credit.
You gotta start somewhere.
Yeah.
So she got approved. So thank for thinking of me. And it's crazy because you never know who you meet. I mean,
Yeah.
we're in the same group on Wednesday mornings, and we sit across from each other. But yet she asked the person next to her, "Do you know anybody that can do loans?" So then they walk her around and introduce her to me.
She was still very new. She didn't understand the whole group yet. That was why.
So-
She was very new.
And
But she knew to ask in the group.
I
That's
did,
right.
and I didn't get a good response out of it. So it was much easier, quicker. I was stunned by the amount of money they wanted to give me versus what I was asking. So it was pretty good process.
Yeah, her situation was different. That's usually I don't see that as much. Usually people want to get the maximum that they're allowed to get. Tamika was like, "They're giving me too much. I don't want." I was like, "Well, you don't need it. You don't have to take it. You can take what you want." So we discussed it. We looked at a spreadsheet. We looked at the numbers and figured out what was best for her in her business.
That is awesome.
But cool. Thank you.
Good job, Robert.
Thank you.